Hello, very good morning to all. I'm Kelvin here again, the Senior Market Analyst of OANDA Asia Pacific. Welcome to today's Daily Dose of Market Insights. Very good morning once again. Today will be Tuesday, the 5th of March, 2024. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This documentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook that I usually does on the broad-based cross-asset classes ranging from the major stock indices, the major FX pairs, as well as West Texas Oil and Spot Gold, XAU/USD, let's have a recap of what has taken shape yesterday and as well as early today Asia session before our daily dose. All right, so let us have a recap what happened yesterday in terms of the key event. Okay, you can see my screen over here. All right, let me take you to the screen. Okay, so what you could see yesterday, we do have a key Federal Reserve official speaking yesterday. So let me expand my screen so that you can see clearer. Okay, so Fed Bostic. So Fed Bostic is among the Federal Reserve officials that is less dovish than his colleague. Why do I say so? Because he keep on emphasizing that he is in favor of not rushing to kickstart that Fed dovish pivot. That means, i.e., to enact the first interest rate cut in US. And yesterday, he added that he expects the Fed to pause after just one rate cut in the third quarter. That means, based on his expectation or his projection in terms of the US economic metrics, in terms of inflation and growth and the GDP growth trajectory, he don't see the US economy falling into severe weakness. So based on his public speeches, especially from the one that's seen yesterday, it seems to us that he is only in favor of one interest rate cut in the third quarter, then after it pause for 2024. So what it suggests over here at this point in time that do not forget the Federal Reserve officials dot plot that was released in December. The last one was in December last year. So what is dot plot? Dot plot is in fact a documentation where the Fed officials attempt to do projection on the Fed funds rate, inflation rate, inflation growth trajectory, and GDP growth in the US. So market participants will be very, very attentive to the Fed funds rate trajectory. Why? Because that actually portray a bit of guidance that they're going to signal to the market how deep they're going to cut or how deep they're going to hike. So last time round in December, the last dot plot release, Federal Reserve officials has a median, we call it a projected Fed funds rate cut of 3 cuts in 2024. So right now, market now has started to more or less move in line with this Federal Reserve dot plot trajectory for the Fed funds rate. So based on the CME Fed Watch 2, market participants are also looking at 3 to 4 cuts for 2024. That has been reduced almost by 50% at the start, where the market is actually penciled in 6 interest rate cut potentially. So based on this Fed Bostic, it seems to us that he's less dovish than his colleague. So it's very interesting to see, especially this coming Federal Reserve meeting, which will conclude on the 20th of March, and they will also start to release their latest dot plot as well to see whether would there be a potential reduction in the Fed fund rate trajectory from 3 to lesser. Okay, if anything that is lesser, that could potentially derail the ongoing bullish short to medium term uptrend in the US stock indices and as well as the global stock indices, something to pay attention to. And earlier this morning during the Asia session, we see the release of Tokyo CPI data. So why Tokyo CPI's data is important for those who are actually have a close watch on Japan economy, especially the FX market in the yen side of the story, is that the Tokyo is a kind of is a major city in Japan. The Tokyo inflation data tends to have a leading element towards the nationwide Japan inflation data that will release around 2 weeks from now. Right, so it is for the month of February. So if you look at the one that is excluding the volatile items, Tokyo CPI, ex food and energy, it came in 2.5%, which was slightly above previously was 2.2%. So if you look at my mouse over here, previously it was 2.2%, only today there was a slight revision to 2.5%. So if you look at the trend of this Tokyo CPI, that means quite a core cost CPI, excluding those volatile items, food and energy prices. If you look at the 5-year trend, it still remain rather, let's put it at a 25-year trend. No? It still remains rather elevated, still holding close to 25 to 30 years of, we call it of high. So it's hovering around 25 to 30-year high based on the Tokyo X food energy inflation, we call it a rate right now for the month of February at 2.5% year on year. So that actually indicate to us very clearly that Japan itself is no longer in a state of going back into a persistent, sticky, deflationary environment that Japan faces in the last 20 years or so. And moreover, this also give the extra, we call it impetus for BOJ to actually starts to decide, or in fact, they may starts to plan pretty much soon, either in the next meeting or so, to start to remove the short-term negative interest rate policy in Japan. And also this coming around a week from now, about 1.5 weeks from now, the middle of March this month, okay, in the middle of this month, we will have the preliminary report of that which negotiation outcome between the major unions and the major corporation in Japan. And this is a very key report where BOJ officials, especially BOJ Governor Yuda, has really stressed in the last few press conferences and his public speeches. He did mention that in order for Japan inflation to remain sustainable at this level, demand pull impact or factors got to be sustainable. And one of the demand pull factors will be a sustainable increase in wage growth. So if we start to see sustainable increase in wage growth in a preliminary report between the wage negotiation between the major unions and the major corporation that's going to be released in the middle of this month, that could actually reinforce BOJ, we call it guidance to starts to actually be less ultra dovish and starts to think about normalizing their interest rate policy in line with the global environment right now. So that could potentially see a bit of yen strength coming back into the FX market. And another data over here was the 2 session in China. So the 2 session in China, why is it important? Today, they actually announced or revealed their GDP growth target for 2024. So no change. We market expectation that's around 5%. But what actually came down was the 54.2 billion special local bonds that's going to issue. So these special local bonds actually being used to fund infrastructure project. So markets are expecting slightly more than a billion, about a trillion, about I think 2 trillion plus, because if you look at the previous target over here, where was it? Yeah, over here. Yeah. So if I look at my screen, that issuance of that local special government bond market is actually penciled in at 4 trillion yuan. You look at my screen, but what the top China policymaker, they only announced officially lesser, 542 billion. All right, so that actually in line with the top leadership, which is presidency pet project in terms of sustainable development. So i.e. the China top policymaker keep on continuing with their targeted stimulus policy. No such thing as opening the floodgates to actually flood the economy with extra liquidity, massive stimulus pumping in terms of infrastructure project and towards property development. There is no that means China right now is not going to follow its playbook during the 2015 to 2016 downturn. So that actually is not in favor of stock market. Why? Because stock market rally that I mentioned to you all earlier, those what you follow my daily dose, the recent 3 to 4 week stock market rally in the China benchmark market spilling over to the Hong Kong Hang Seng Index. So that is actually the also a China proxy as well. It's much more of a counter trend rally rather than a start of a major bullish uptrending phase, because i.e. technically it does not support it, fundamentally it does not support it as well. Okay, and most important over here is that China policy making is getting more and more closed door and opaque, and that does not gel well if with international market participants, or i.e. international investors. Why? Because usually after the release of this key GDP target for 2024, and as well as China key economic initiative on how to achieve this 5% targeted growth GDP target for 2024, the premier, so this time will be Premier Li Qiang, will actually host a ex-post meeting press conference with the local press as well as the international press, based on the tradition of the last 30 years, in the last 30 years. But however, this time around, the China top policy makers will in fact scrap away this Premier Li briefing. All right. So this is for sure implying to us that China does not want the press to know what is their top policy makers thinking in terms of how to actually navigate China deflationary risk scenario, China deflationary risk spiral right now that is still uh, inherent in the China economy. And also China doesn't seem to be interested in using the stock market or the capital markets to drive growth anymore. Because if they are interested in using the stock market or capital markets to drive growth, they shouldn't be less transparent in terms of conveying their message to the international press. But instead right now they are doing the reverse. So this also supports the way they are doing things. I mean, actions speak louder than words. They are likely support. This is not supportive of the start of a potential major bullish trend in the China stock market or the Hang Seng stock market, despite the fact that they have the lowest forward PE ratio in terms of valuation against the rest of the world. All right. Now, now that is one thing, and also on the geopolitical front, AMD, which is a key major US semiconductor firm, has been put on a roadblock by US lawmakers in selling AI chip tailored for China. So right now, the Commerce Department starts to bar export of powerful AI processor, and not right now, AMD seems to facing a roadblock as it's try to actually navigate a lobby against this roadblock that is being issued by the Commerce Department. So for sure, in terms of geopolitical risk between US and China is still real. So even though some press conference may see that presidency and Biden shaking hand 3 months or 4 months ago, but behind the scene, the US China tech war is still pretty much intact, and potentially this could start to ramp up again coming to the US election, especially if, who knows, President Trump starts to get re-elected again and he starts to reinstate his mega make America great policy. That is, one of them is to actually target China industry by imposing a significant amount of tariffs on China products. Okay, so that also doesn't gel well for the China stock market and the Hong Kong stock market in the longer term. All right, so yesterday's US stock market was rather lackluster. So if you look at the US stock market performance yesterday, was more of a consolidation pace. The SPX down negative 0.12%, the Nasdaq down negative 0.42% due to a very weak performance of Apple. Dow Jones Industrial Average negative 2.5%, the Russell 2000 negative 0.10%. So it's more like a pullback scenario. But whereas for spot gold, we continue to see a strong strength as it staged a bullish breakout right from a major range resistance that was in place since August 2022, breaking above the 22,090 level yesterday. And yesterday rally Okay, it managed to add additional 1.52%. So something very interesting in spot gold right now, as it broke above this major range resistance that is in place since August 2022, increasing the odds of the start of a medium term to major term potential impulsive upleg sequence. So later we covered more on the short-term technical outlook for spot gold. Okay, so short term, what does it mean by short term? That means we are talking about a 1 to 3 days time horizon. Okay, so this is the heat map of the S&P 500 yesterday. So this is what the culprit that causes the the Nasdaq 100 to underperform was the S&P, not the S&P, the Apple down negative 25%, as well as Google down negative 8, now down negative 2.8%. Okay, then the one that is still holding the fort will be the AI optimism team play, the market leader, Nvidia, positive 3.6%. All right, so right now let us now jump straight into the short-term technical outlook on the major indices first. So let us start with the local Asia indices. Okay, starting from the Japan 225. All right, so before that, let me expand my screen so that you guys could have a better view of it. So if you still recall, for those who joined our daily dose of market insight yesterday, we do point out that the Nikkei 225 has come close to a key resistance level, which is at the 40,490 / 40,690 level, and the hourly RSI has started to flash a bearish divergence on last Friday US session, indicating to us that it's a high risk right now of the Japan 225 to do a mean reversion bearish decline scenario within its short to medium term uptrend that is still intact. Why? Because price action going to hold above the 20 and the 50-day moving average. So all in all, what we could see over here is that we will continue to maintain this short-term bearish bias for this potential we call it mean reversion decline scenario to play out, as long as 40,490, 40,000, pardon me, 40,490, 40,690 short-term pivotal resistance is not surpassed to the upside. Supports level to watch in the short term will be 39,640, followed by 39,260 level. Only hourly close above 40,690 will invalidate this mean reversion decline scenario to kickstart or to resume its bullish impulsive up move sequence to expose the next resistance level at 40,980, followed by 41,4675 and 41,660. Right. So over here, we also be mindful on the daily chart as well. So on the daily chart, it also starts to come close to a major resistance element, where price action has starts to formulate a kind of a daily bearish morning star evening star scenario by a long bullish candlestick. Yesterday it gap up from a spinning top, and today it gap down. All right, so this is a potential bearish reversal candlestick pattern on the daily chart called evening star. And where does it form? It forms at the that resistance level that I highlighted earlier on, and also close to the upper limit of this major ascending channel from around 3 years ago, from the low of March 2020 low. So something to bear in mind as well. Right now we have higher time frame technical elements on the daily chart that is actually flashing this signs of potential mean reversion decline scenario coming into play for the Nikkei 225, i.e. the Japan 225 index. And for now, the Hong Kong 33 index, the Hang Seng 33 index, continue to remain weak. So it actually right now in today's Asia session, it's going to sell off, down negative around 1% for now, refusing to break above yesterday's minor swing high area at 16,670. And if we look at the current situation now, especially on the daily time frame, so this is the daily time frame on the Hong Kong 33 index, so which is the Hong Kong 33 index in our platform. And if you look at it over here, yes, the price action is still holding on above this ascending trend line support from the low of 22nd of January. But however, if I were to put it in parallel with its momentum indicator, the daily RSI, the daily RSI has already starts to break down. See, price action hasn't break down, but daily RSI has already broken down. So this is giving us a kind of leading element that there's a high chance that this potential up move or counter trend rebound is likely to be ended. High chance. Why high chance? Because the momentum indicator, the RSI, has already broken down its parallel trend line support level. And why RSI has a leading element over price action, pure price action? Because RSI, like I say, is a momentum indicator. It's a derivative of price action. Anything that is measuring kind of a rate of change always has a leading element. Think of it about it as a car. In order for a car to stop, it got to slow down its speed first. So RSI is telling us that this counter trend rebound on the Hong Kong 33 that was in place since 23rd of January has already starts to slow down its speed. All right, so with that bearish element that is being seen on the daily RSI indicator of the Hong Kong 33 index, we will be less convinced right now to maintain that short-term bullish bias that we have since last week on the Hong Kong 33 index. We'll be flipping to a bearish bias instead right now, using 16,670 as a short-term pivotal resistance level. To flip to a bearish bias, that means i.e. we are now seeing potentially the end of this minor counter trend rebound that took shape from the low of 22nd of January. First support level to watch 16,140 slash 15,950. A breakdown 15,950 exposes the next near-term support level at 15,455, which is the minor swing low area of 5th of Feb and 14th of February. And as well as if we do the Fibo retracement of this minor counter trend rebound, it's actually close to the 61.8% golden ratio as well. Only an hourly close above the 16,670 short-term pivotal resistance will invalidate this short-term bearish bias that we have on the Hong Kong 33 to kickstart or to resume that minor counter trend rebound scenario, with the resistance level to watch on the upside potential be at 16,860, followed by 17,010, 17,130. German 30. So German 30 no change yesterday, continue to trade sideways, still holding above the 17,690 short-term pivotal support level that we have. So we'll be still using this 17,690 short-term pivotal support to maintain our short-term bullish bias on the German 30 index. With the next resistance, with the first resistance to watch will be at 17,840 slash 17,890. Only hourly close below 17,690 will see the extension of this minor corrective pullback or decline to retest 17,450 support level. US indices, Dow Jones Industrial Average, or we call it the US Wall Street 30, traded sideways above the 38,770 short-term pivotal support that we have. So no change for sure. 38,770 short-term pivotal support is a key support level to maintain this ongoing preferred short-term bullish bias that we have on the US Wall Street 30, also corresponding with the upward sloping 20-day moving average and the lower boundary of this medium-term ascending channel that I drew from the low of 18th of January. It got a breakout above 39,100 to add a bit of importance for the boost, with the next intermediate resistance to come in at 39,400 level. Only an hourly close but below 38,770 will negate this bullish tone to see another round of minor corrective decline pullback to retest the minor swing low area of 22nd of February. I think as a next support level, I think as a next near-term support level of 38,430, 38,430 level, also confluencing with this upward sloping 50-day moving average that is coming close to as a support level as well. Okay, the confluence towards the 38,430, 38,360 level. Nasdaq 100. So Nasdaq 100 continue to shape that minor pullback as expected. So this minor pullback going to hold above the 80,030 short-term short-term pivotal support level that we have yesterday. So no change. Any potential this minor pullback managed to hold at the 18,030 Titan key short-term pivotal support level that we have. We will still maintain that short-term bullish bias on the Nasdaq 100. Next resistance level to watch will be at 18,430 slash 18,470. Only an hourly close below 18,030 will see the extension of this minor corrective decline to retest last Thursday minor swing low area at 17,810. All right, so all in all, we do have a mixed bag short-term technical outlook for the major US stock indices. We maintain that bearish bias on the Japan 225, flip to a bearish bias, short-term bearish bias on the Hong Kong 33, maintain that short-term bullish outlook on the Nasdaq 100, the US Wall Street 30, as well as the German 30 index. Right, FX market rather mixed yesterday. So if you look at overall the trend of the FX market, I'm going to share with you. Yeah, so this is the 5-day rolling performance based as of 5th March, as of today. Right now, what we see over here is a pretty much sideways movement of the dollar against the major currency. Okay, so it's pretty much mixed bag what we could see. So let us start with the European currency, the euro dollar. So euro dollar, no change, continue to remains above the 200-day moving average and above this 20-day moving average, and it seems to us that it started right now to evolve within a minor ascending channel from the low of 14th of February that I drew. So no change as long as the 10810 short-term pivotal support holds. We will still maintain that short-term bullish outlook on the euro dollar, with the first resistance to watch for sure is at 1.0890. Only a clearance above 1.0890 will add potential impulses to expose the next intermediate resistance zone at 1.0935/1.0950. We are so close to the upper limit of this minor ascending channel as well. However, an hourly close below 1.0810 level will invalidate this short-term bullish bias on the euro dollar to see another round of choppy minor corrective decline scenario to expose the next near-term support level at 1.0785, followed by 1.0760. Sterling dollar. So the pound continues the same scenario and is going to trade above the 20-day moving average and manage to hold above this minor ascending trendline support that I drew from 14th of February. So potentially the RSI now yesterday it managed to inch down slightly from the overbought level. So we could see a bit of pullback taking shape. So yesterday there was a 1, 2, 3, the third retest of this key minor range resistance that has been resisting it since 22nd of February, which is the 127 figure level that we've been highlighting since late last week. So potential a minor pullback could take shape. Near-term support level to watch will be at 12650, which is also correspond to this 20-day moving average coming to act as a support level soon as well. But I do not want to type the key short-term pivotal support level to so tight at 12650. I'll still use 12610 level. So as long as any potential pullback manage to hold at the 12610 short-term pivotal support, we will still maintain that short-term bullish bias on the sterling dollar, but it got to have a clear breakout above 127 figure level in order to add extra impulses to expose the next intermediate resistance zone of 12740, 12760 region. Only an hourly close below 12610 will invalidate this short-term bullish bias on the sterling dollar to kickstart another round of choppy minor corrective decline scenario to expose the 200-day moving average that is acting as a support level at around 12560/12540, which is the minor swing low area of 14th of Feb and 15th of February. Asia Pacific currency, Aussie dollar. So Aussie dollar right now is getting really bad choppy over here. So yesterday it refuses to break above the 20-day moving average very clearly and reintegrate back below it. So given the fact that why the Aussie dollar is trading so lackluster right now is also due to the fact that Australia has a strong direct trade relation with China, and given the fact that China right now, based on whatever policy that we start to show, they are not in favor of enacting massive infrastructure stimulus plan, especially with the lesser than expected issuance of that special government bond over here. Okay, they only decide to issue 542 billion special local government bonds instead of a market that is looking at 4 trillion yuan. So that actually indicating to us that they are in no hurry to jumpstart massive infrastructure spending. And don't forget, infrastructure spending, they required we call it hard commodities, industrial commodities like zinc or iron ore, which Australia is the key supplier to China. So with that, that actually took a damper on the Aussie dollar. at least in the short term. So with this scenario coming into play, and technically the hourly RSI has started to break down below a parallel key support level that I drew for my over here, is indicating to us that upside momentum seems to be lagging in the Aussie dollar again. So I'll be using yesterday's swing high area of 165.30 level. Okay, 65.30 level. There also confluence to last Thursday swing high as a short-term pivotal support level. Flipping to a short-term bearish bias within this very complex sideways range configuration that the Aussie dollar is trying to play out. First support level to watch 64.90, followed by 64.70, then thereafter 64.40 level, the lower boundary of this complex sideways range configuration. Only an hourly close above 65.30 potentially will see the Aussie dollar to actually see a kind of push up towards the top of the range configuration at 65.60. We saw 65.80. We also confluence with the 200-day and the 50-day moving average that is still acting as a resistance level as well. So for sure, the Aussie dollar right now is neither here nor there. It's not trending within a impulsive up move or impulsive down move. It's more trapping within in a complex range configuration. Right now, similar for the dollar yen as well. So the dollar yen as well going to remains stuck below that short-term pivotal range resistance that we have, 150.70, 150.80. So as long as this level is not surpassed to the upside, we will still maintain that short-term bearish bias within its range configuration. First support, a lower limit of the range to watch will be at 149.60 that has been tested on last Thursday before it where it actually survived. So for sure this will be the first support level to watch, or that minor range support level. Only a clear breakdown below 149.60, that means an hourly close below 149.60, will unleash further potential weakness on the dollar yen, at least in the short term, to expose the next support level at 148.80, 148.40. Only an hourly close below 150.80 will see a squeeze up to test the major resistance zone of 151.40/151.95. Spot gold continue to actually pierce up over here. So yesterday we do expect a kind of pullback, but the pullback didn't take shape and burst above the 2090 level and all the way hit the first resistance level that we highlighted, 2117. So right now 2117 over here, potentially there could be a bit of a pullback over here. So I do not want to use the 2090 level as my key short-term pivotal support for that pullback. Okay, so this level will be a support level. So what's 2090 is in fact very clearly this range top here. Okay, and also like I highlighted earlier on the daily chart, okay, this is the 2090 level, a range resistance. If you go to the weekly, a range major range resistance that has been in play, this dotted red line 2090, the upper limit, has been in place since 7th of August 2020. All right, so I do not want to use so I will do slightly lower as long as they pull back, manage to hold above 2079. So what's 2079? If I do the Fibo retracement of this entire squeeze up, all right, it's close to the 38.2% Fibo retracement, and if you take the entire move from 14th of February, it's around the 23.6%. Okay, slightly below it. Okay, so the 23.6% is 2090. Okay, so I'll use the slightly below one at 2079 short-term pivotal support. So as long as any potential pullback manage to hold above 2079 to prevent any potential whipsaw if I use 2090. So this ongoing bullish bias on spot gold, at least in the short term, remains intact. Next resistance to watch will be at the current all-time high level that was printed on the 3rd of December over here. Okay, or the 4th of, yeah, pardon me, yeah, the 4th of December 2149. Only if we start to see an hourly close below 2079, then we will start to see a much more deeper corrective minor pullback to retest 2064, the minor range resistance from 6th of Jan to 2nd of February. Now turns into a pullback support, and a breakdown below this level will see a potential mean reversion scenario to retest 2040. We also confluence with the upward sloping 50 and the 20-day moving average. WTI crude oil, West Texas oil. So West Texas oil yesterday we flipped to a short-term bullish bias because of the break above the 78.40 range, medium-term range resistance of the symmetrical triangle. the one that is dotted gray line over here. So right now it's attempting to has already pulled back right at this former upper limit of the symmetrical triangle range configuration, also slightly below the 200-day moving average, and as well as the 20-day moving average, also coming to act as this support level, where we highlighted yesterday, which is the 78.14 short-term pivotal support. So still no change. I'll be using the 78.14 short-term pivotal support level to maintain that short-term bullish outlook on West Texas oil, with the next resistance level to watch will be at 81.65. Only an hourly close below 78.14 will invalidate these short-term bullish bias on West Texas oil, and will also increase the odds of a failure bullish breakout that we see on last Friday for the price action of oil to reintegrate back into its symmetrical triangle range configuration, with the next to expose the next near-term support zone of 76.20 slash 75.75, which correspond to the minor swing low of 15th of February and 26th of February, and conferencing with its upward sloping 50-day moving average as well. All right, so that's actually sum up the short-term technical outlook on the broad-based asset classes. So before we go, let us take a look at the economic calendar again on what are the key economic data to look out for today. Okay, so for today, the rest of the European session will be pretty much quiet until the US session opens, where we have the all-important ISM Services PMI, which is much more important than the manufacturing PMI. Why? Because the US economy, close to 3/4 of them is determined by services, the services sector. So market is still expecting a rather robust services activity in US, where market continue to pencil expansion of 53, very much almost unchanged from the 53.4 level that was printed in January. Then on top of that, then we do have another Federal Reserve official speaking, Fed Barr, at 1 a.m. Singapore time. And later on, right in the early Asia session, at 8:30 a.m. tomorrow, Australia will release its Q4 growth rate. All right, then with that actually pretty much sum up with the key economic data calendar data to watch out for today. So with that, do have a great day ahead, and I shall speak again with you guys tomorrow. Thank you.